Have you ever wondered what dollar cost averaging is and how it can be a good strategy amid market volatility? Well, you're not alone. This financial strategy is often mentioned in the same breath as investment stocks and market fluctuations. But what exactly is it? And how can it serve as a safety net during turbulent market conditions? Dollar cost averaging is a technique that has been used by investors for decades. It's a simple yet effective way to invest your money in a way that could potentially reduce the impact of market volatility on the purchase of investments. Now, if the word volatility gives you jitters, don't worry. Volatility is just another term for the ups and downs, the highs and lows of the financial market. To understand this concept, we first need to delve into what dollar cost averaging actually is. So let's dive right in and unravel the mystery of dollar cost averaging. But before we continue, if you like this video, please remember to share it with your friends, hit the like button, subscribe to the channel, and then watch some more of our videos. So, what is dollar cost averaging, you may ask? Well, let's dive in and explore this financial strategy together. Dollar cost averaging is a simple yet powerful approach to investing. It involves consistently investing a fixed amount of money in a particular investment over time, regardless of the price of that investment. Imagine this. You're at a fruit market, and you've decided to buy apples every week for the next couple of months. Some weeks the price per apple is high, other weeks it's low. Instead of trying to predict the best time to buy, you simply purchase the same dollar amount of apples each week. Some weeks you'll get more apples for your money, other weeks you'll get less. That's the basic concept of dollar cost averaging. Now you might be thinking, why would I do that? Wouldn't it be better to buy when prices are low? Well, that's a common question, and the answer lies in the unpredictability of the markets. You see, financial markets are like the price of apples, they fluctuate. Sometimes they're up, sometimes they're down. Predicting these changes accurately is extremely challenging, even for the most experienced investors. By investing a consistent amount regularly, you're not trying to time the market. Instead, you're taking advantage of the market's natural fluctuations. The main idea behind dollar cost averaging is to reduce the impact of volatility on large purchases. If you were to invest a large sum all at once, you run the risk of buying at a peak price. However, by spreading out your purchases, you can mitigate the risk of buying at a high point. Dollar cost averaging is not about making a quick profit. It's a long-term strategy designed to smooth out the ups and downs of the market, making it a more manageable and less stressful way to invest. Now that we understand what dollar cost averaging is, you might be wondering how it works in practice. But before we get into that, it's important to remember that all investment strategies carry risk, and dollar cost averaging is no exception. Always do your research and consider your financial situation before making investment decisions. How does dollar cost averaging work? It's simpler than you might think. This strategy is all about consistency and patience. Let's imagine you have a certain amount of money you want to invest. Instead of investing it all at once, you divide it into smaller portions and invest those portions at regular intervals, regardless of the market's current condition. Let's say you've decided to invest $1,000 every month into a specific stock. In a month where the stock price is high, your $1,000 will buy fewer shares. But don't despair, because when the stock price drops the next month, that same $1,000 will buy more shares. Over time, this will lead to an average cost per share that is lower than the peak market price. The beauty of dollar cost averaging is that it takes the guesswork out of investing. You don't have to worry about the perfect timing to invest or fear that you might invest a substantial amount at the wrong time. By spreading your investments over time, you're cushioning yourself against fluctuations in the market. What's more, dollar cost averaging can be a psychological comfort. Investing can be an emotional roller coaster with the highs of market peaks and the lows of market dips. But with dollar cost averaging, you're not trying to time the market or make quick gains. You're playing a longer game, and that can make the ride a little smoother. To illustrate, imagine a seesaw. On one end, you have the potential for quick gains by investing all at once. But on the other end, you have the risk of investing at the wrong time and suffering significant losses. Dollar cost averaging helps balance this seesaw. It might not always lead to the highest potential gains, but it also reduces the risk of substantial losses. So we know what dollar cost averaging is, and we understand how it works. But why should you consider this strategy, especially during times of market volatility? Why should you consider dollar cost averaging, especially during times of market volatility? Let's delve into that. Picture this. The market is on a roller coaster ride with prices moving up and down unpredictably. This is where dollar cost averaging shines. By investing a fixed amount regularly, regardless of the share price, you can potentially lower the average cost per share over time. When prices are low, your fixed amount buys more shares. When prices are high, it buys fewer. So in volatile markets, you're actually purchasing more shares when prices are down, setting yourself up for potential gains when the market rebounds. But there's more to dollar cost averaging than just the numbers. It's also about mindset. Investing can be an emotional endeavor, and market volatility can trigger impulsive decisions like panic selling at the bottom or greed buying at the top. Dollar cost averaging helps to take the emotion out of investing. By sticking to a regular investment schedule, you're less likely to make hasty decisions based on short-term market fluctuations. In essence, dollar cost averaging provides a kind of safety net during market downturns. It's a slow and steady approach that aims for long-term growth rather than quick wins. It's about consistency and discipline, not timing the market. Dollar cost averaging can be a viable strategy for many, but like any investment strategy, it's not without its risks. In conclusion, what have we learned about dollar cost averaging today? This strategy involves regularly investing a fixed sum, independent of the investment's price. It can potentially lower the average cost per share, offering a cushion during market downturns. In volatile markets, dollar cost averaging can prove to be a beneficial tactic, providing a level of security. Remember, understanding your investment strategy is key to navigating any financial climate. Keep exploring, stay informed, and happy investing. If you like this video, please remember to share it with your friends, hit the like button, subscribe to the channel, and then watch some more of our videos. Thanks for watching.